Hello, good evening, everybody. Hope you had your dinner. And thank you very much for joining us tonight. If you can hear me and can you just comment yes so that I can know that you are your arms and foot are off. Well, so just say yes if you can hear me clearly.
All right. Okay, right now, if you can hear my voice properly. So if you can hear my voice and right now should be okay if you try. Let me test it again. All right. Awesome. Thank you so much, guys. Well, okay. Once again, welcome to our investors copy, our session for tonight. All right, which is a webinar brought to you by Bursa Malaysia. So we're going to talk about how you can maximize your profits and minimize your risk with a sound investment portfolio. So what we're basically trying to do is to build a foundation on how you can actually build a portfolio depending on your risk profile. All right. So we're also going to take a look at how you can actually evaluate yourself. Okay, but of course the best way to evaluate is you have to invest and start investing in the stock market yourself. All right, so let me just share my screen, and please share this with your friends if you have any friends who may benefit from today's session. I know it's a Saturday evening, so that's why I really appreciate you guys for spending these 1.5 hours with us and to learn or to sharpen your investing skills, to be a well-informed investor. Right, so that's what we want to achieve. So hopefully the session today will give you an idea what's having a portfolio is all about and how you can build a portfolio according to your risk profile, according to your resources, according to your skills, and so on. All right, so let's just me share my screen. All right. Okay, so today's session is about building a portfolio. So it's a foundation on how you can actually build a portfolio, to give you an idea roughly how to build one. All right, and this is actually a follow up to last week's or the last webinar's presentation, on balancing your reward and risk. All right, so it's actually a follow up. So if you missed that, please do look at the webinar video, and then so that you have a better idea. All right, now if you need more information and you want to learn more from Bursa Malaysia, because they have actually built a Bursa Academy, which is an e-learning portal by Bursa Malaysia, right? So just log on to www.bursaacademy.bursamarketplace.com. It is right in front of your screen. And of course, when you download the slides later, you should be able to get that link as well. All right, so please do check them out. It's a new portal where you are able to learn more about investing in the markets. All right. Okay, I don't need to go and present myself, but this I have to do. All right, disclaimer: whatever that's being shared here today or even discussed here today is basically for informational and educational purposes. Right, it's not intended as any investment advice or whatsoever. So if you want to look for investment advice, please do look for a professional and licensed investment advisor. All right, so let's go on now. What is a stock investment portfolio? Right. So basically, it represents the amount of capital. They can be cash or stocks or any other commodities that you are trading. Because we are talking about stocks this evening, so most of the reference will be based on stocks or cash. right? So that's the capital that is injected to a portfolio, an investor who wants to invest the money, all right, over a period of time. So I'll also mention to you that there are many different kinds. There are basically two main kinds of portfolios that you can create, right? It's really up to you how you want to create it, right? So portfolio is important because I'll give you an idea later on why is it important, and I think Alvin has also already mentioned this in our previous webinar. You can go and check it out. All right. So basically, a portfolio consists of cash, all right, or equities, okay, or any stock holding. So it can be any other commodities, or it can be any other investments, or not just equities. Like I said, since we are in the topic of stocks, so we're gonna mostly give reference to stocks. Okay. So to give no to know you guys, maybe you can participate a little bit and let me know any one of you actually have a investment portfolio. So if you have an investment portfolio, that means you already created one to achieve your financial objective. Just type one on the comment section. All right, that means if I assume that a few hundred of you guys, that if you do not type one, you do not have an investment portfolio, right? It's basically just buying and selling shares without keeping or without monitoring a portfolio of stocks that you have. All right, so type one if you already have a portfolio, right? And if you don't have, then you don't need to do anything. All right. Okay, so one stock cannot be considered as a portfolio. Even if you have two stocks, if you hold two stocks and you monitor the two stocks in a portfolio, that means you have a portfolio. So you can have also just one or just two stocks, but minimum two lah, right? Because if you invest only one stock, then of course it's only one egg lah, right? Now, thank you very much. Thank you very much for your response. Wow. Okay, you guys do have a portfolio. All right. Now, there are basically three different types of portfolio. Of course, there are two main types of portfolio, right? Now, the first one is called a closed-end portfolio. It means that you put your money one time, right, in the beginning, and you leave it for some time. I'll explain in a short while. All right. Then you have a closed-end plus top-ups. Okay, that means when you start investing, when you start putting the capital beginning, but you also add more as we go on. All right. Then the third one is an open end. Open end is where you can withdraw anytime. You can also add anytime you want. All right, into your portfolio. So to give you an example, most of the unit trust funds, all right, are open-ended funds. Because you can actually buy and sell, right? Buy and sell. You can get into the fund, you can sell in the fund. A closed-end fund you can't. A closed-end fund means when you start investing, let's say 3 years, and upon maturity after 3 years, then only you can withdraw. All right, so that's a closed end. So you can't top it up, you can't withdraw. Okay, but the open end one, which is most we're all familiar with, which is mostly done by the fund managers. All right, a unit trust or mutual funds, they are mostly open end funds. Okay, closed end plus top ups, that's your own one now, right? You can continue to top up. Okay, as long as the portfolio is still running. So open-ended portfolio, all right, you can deposit money and then you can of course reinvest your dividends again. You buy more units, right? Or you can withdraw as well. Okay. So this one is where withdrawals are allowed. That means you can withdraw, okay, after you putting an initial amount, or you can top up more into your portfolio. So this one is a little bit more difficult to calculate when it comes to when you calculate the percentage of returns. How you want to calculate your returns, especially the annual returns, right? It's easier to do a one sum or a full returns, right, upon the end of your investment portfolio, because you just look at the beginning and the ending and see what the returns are. But you want to calculate annually, because you top up and you withdraw, then the calculation can be a little bit complicated. So a closed-ended portfolio, okay, you put deposit, the dividends can be reinvested, right? You can just add into your portfolio again. It is consistent, it's not, but you can't withdraw. All right, so a closed end, you can't withdraw. Okay, of course, the other one is you can continue to top up, but you can't withdraw as well. So it's almost same like the closed end portfolio lah. All right. So the closed end one, you just reinvest your dividends, whereas the closed end portfolio plus the top up one, you can actually put in more money, put in more capital, additional capital. All right, so that's the difference. So closed-end portfolio, you cannot do anything. Once you put your money in there, but your dividends can be reinvested back into your portfolio. Then you can actually compound it. So that's not a problem, right? So if you want to plus the top up, then again, the calculation on your KEGA or your annual returns would be different again. Now, so there are two methods of measuring the portfolio. One is the absolute return. That means for all the three portfolios, you can just calculate your absolute return after the end of your portfolio, right? So for example, let's say okay, you invested 100,000 ringgit in the beginning. After 5 years, it goes to 300,000 ringgit. Okay, so that means you have made 200,000 ringgit, which is 200% returns. Let's say including dividends and all that lah. So your absolute return is 200%. Okay, from 100,000 to 300,000 in, let's say, 3 years. Okay. And then the other way is to calculate the compounded annual growth rate, or KEGA in short, right? So when people mention about KEGA, it means the annual compounded growth rate. All right. So this one, you can use it to calculate on the closed-ended funds or closed-ended portfolio, because you don't continue to top up and withdraw and top up and withdraw, and then your calculation of the annual returns will be different. All right, so this will be the second one can only be applied or easily applied on the closed-end portfolios. Okay, closed-ended portfolios. All right. So this is an example of a absolute return, right? For the beginning of your capital, the beginning of your portfolio, all the way up to your end of the portfolio, and to see your returns. All right. Okay, so this is the formula. It's basically your total portfolio value minus your capital divided by your portfolio capital, right? That's your absolute return calculation. Now, the other way to calculate is the compounded annual returns. Okay, this is calculate over 2 points, over, let's say, over a period of 5 years. You can of course calculate the absolute return for 5 years, but if you want to calculate what's your compounded annual return, then you can use the KEGA formula. And basically this is the KEGA formula. All right, now you can, if you want to go back and figure out how this calculation is how do you make sense of this calculation, you can go back and try. But of course, you can go and read a lot about KEGA on the internet, right? How it's being calculated. So it's basically, the reason why we have the KEGA formula is compounded is because your money, your dividends is being reinvested back into your portfolio. All right. And then every year you reinvest back whatever amount of capital that you have gained or lost. All right. And it keeps on compounding towards the end of your portfolio. Okay. Now, what I want to share with you is this thing called Rule of 72. This is important to basically know what kind of returns that you'll be expecting. All right. And investing, one of the things that you have to do is basically to have an end in mind. That means what kind of returns do you want to achieve? All right. Once you find out what kind of returns you want to achieve, then you find a investment plan, all right, or a strategy or a technique on how to achieve that objective. Okay. So for example, if you are a very aggressive guy that wants a return of 100% a year, that means every year I want my capital to double. Okay, so question is, now that I have a plan of 100% returns a year, how do I achieve it? All right, and I'm not talking about achieving it in 1 year. In fact, if you started invested this year and you buy rubber glove companies or you buy any other companies, you would have made money, right? You could have easily double up, triple up, or even 4 or 5 times. Okay, but I'm talking about consistency, right? Over the past 5 years or 10 years, can you make 100% consistently over the period? All right, then you have to find a trading plan, all right, or an investment plan to achieve the 100%, right? Whether you are able to achieve that 100% portfolio consistently. All right. Now you have to bear in mind as well. You have to also, think about the returns that you'll be expecting. All right, because even the world's right now, the richest man in the world, which is Warren Buffett, but right now it's Elon Musk. Elon Musk has taken over Warren Buffett as the richest person in the world. But of course, he's one of the richest. So Warren Buffett compounds about 23% annually, right? So that means every year he makes 23% of his whatever capital that he have, and it's compounded over the years. All right. So if you can make above 23% over the years by investing, then you are as good as Warren Buffett. All right. Of course, it takes some time before you can see how compounding interest grow lah. So that's why I want to share with you the rule of 72, which is a very simple way of calculating, um, uh, you know, the years it takes to double up your money. Okay, so with the 23% in mind, let's take a look at how many years does Warren Buffett take to double up his investment, right? How many years? Okay, by using the rule of 72. Now, um, so it's important to have, if you're 100%, yes, you can still achieve 100%, but you will not be investing. You probably have to be more actively trading. All right. If you want to invest like Warren Buffett style, where you just buy and hold for a little bit longer term, then you need to give it time, be a little bit less active. Then yes, you can achieve that kind of 25% returns, 20% returns. But if you really want to achieve 100%, then you have to find something which is more aggressive. All right, which is like trading short term. Okay, if you want to achieve some traders even want to have want to achieve like 200% or 300% returns a year, which they can if they are trading in a more let's say highly leveraged product like the futures market, right? They can go through that because futures market give you leverage. You can achieve that objective, of course, very fast. But if you do not know what you're doing, you can also lose money, right? Because basically leverage is a double-edged sword. Okay, so let me just get back to the rule of 72 now. So you take the number 72, divide by the interest in percentage. That will be roughly the number of years to double your investment. All right. So now, assuming, let's say that Warren Buffett makes 24%, right? 24% a year. So if you take 72 divided by 24, that'll be how many years? Okay, do you guys want to answer? That's what I'm talking about. Warren Buffett. I'm talking about 24% interest, right? So if it's 24% interest, 24% returns, how many years does it take to double the investment? Okay, I'm just going to give you a few seconds before I go on. Thank you, Roslan. Okay, simple calculation, right? So that means Warren Buffett grows in investment, it doubles up his investment every 3 years. I think 3 years, it looks little, but imagine you calculate, you start, let's say, from 50,000, right? After 3 years, it becomes 100,000, right? After 6 years, it becomes 200,000. Okay, after 9 years, it becomes 400,000. After 12 years, it becomes 1.2 million, right? After 12 years, it's 1.2 million from 100,000. And yeah, after 15 years, it becomes 2.4 million. It doubles up. So if you look at the compounding interest, basically you are looking at a growth which is not just stagnant. All right. Initially, you don't see that much movement, but over the years, the growth of your investment will just grow exponentially. Okay, so that's the power of compounding interest. Okay, so it needs to take time. So imagine if you're able to make, let's say, even let's say 40% lah. Okay, 40% a year. Okay, 40% a year, it takes you less than 2 years to achieve or to double up your money. And of course, if you put 100% means every year 100%, then you will grow your money every year lah, right? That if you can achieve. So if you, let's say, put if your interest is 15%, then it takes 5 years to double up your money. All right. So it's important to have an idea, all right, of what kind of returns that you'll be expecting. Then you'll try to find ways to achieve it. All right. Like I said, the higher target you want to achieve, the more active you have to become. All right. Now, one of the things that we have to consider before we even invest is your risk profile. See, the thing about investing is, yes, you may have the same techniques, the same strategies, the same investment plans, but not all can actually achieve the same results. All right, and that's a fact, because we can teach everyone the same thing, right? But the results varies. The results is different for every investor. Okay, I don't see anyone who have the same exact results. Right? Why? It's because of their risk profile. Okay, the amount of capital that they have, the risk profile that they have. So I'm just going to cover a little bit on this so that you have an idea on how to evaluate your risk profile. All right, this is just an idea, lah. Right? Um, so stock investment involves the risk of losing money. Everyone agree, right? So it's very important to know how much a person can manage risk by losing money, because losing or investing or money is very, very emotional to everyone. All right, nobody wants to lose even a single ringgit. Okay, if you agree with me, right? I'm sure you agree with me. You all don't want to lose even 1 cent, right, or 1 ringgit. Um, but in investing, because we are expecting certain returns, definitely we'll have to take some risk. Okay, but the risk that we want to take is basically calculated risk. Okay, we know what we are doing. As long as it doesn't kill me, as long as it doesn't destruct me financially, then I'm willing to take that risk. All right. So everybody has a different risk profile. If you ask someone who goes to casinos every time, then their risk is very high, lah. Their risk tolerance is very high. All right. If it's someone who don't even want to lose 1 cent, or can't even give, let's say, a 1 ringgit to a beggar who really needs some money, that means you don't even want to lose a single cent. That means you don't want to take any risk at all on your money. All right. So let's take a look at a few. Right. Now, there are basically three components of a risk profile assessment. That means how you can actually assess your risk profile. Okay. Now, the first one is the capacity to take risk. Right. The capacity to take risk is a measure of how much risk you are capable of taking given your current situation, your current financial situation. Okay. And age has normally play a very important factor. As we grow older, okay, our capacity to take risk becomes lower. All right. Why? Because if, let's say, when we are still young, out of school, just starting work, there's no dependence, and you can lose all your money and still go back to your parents. um, you can it doesn't matter, right? You lose money or not, okay? Because the money is yours. So when you are young, you tend to be more aggressive, you tend to take more risks, right? In anything, whether it's got to do with money or whether it's got to do even with your life, right? The younger people are willing to take more risk. Okay, they will go, all the extreme sports, roller coaster, bungee jumping, or whatsoever when you are young. Okay, but when you are getting older, I don't think so we want to do bungee jumping anymore. All right. So age is an important factor, right? Those who but it's quite weird because when it comes to investing, when we were young, if let's say we were not born rich, right, with a lot of money, when we were young, we don't have that enough money to invest, right? And that time we were able to take big risk, right? We are more gung ho, but no money to invest. Okay, but as we age, right, when we get more money, right, and then but our risk profile becomes lesser, right? And then when we start investing, also is very difficult because we do not want to lose a lot of money, right? But there are some people who are willing to take that risk. Okay? So we need to know really, what's your risk profile. Yeah. So age is one factor. Second factor is your nature of income, right? So for example, there are a lot of people ask me how to start full-time trading. Okay. So I mean, if you really want to know, if you can survive for the let's say 6 months without any income, or let's say 1 year without any income, and you already have a trading plan, then you can start, right? Because trading, you never know, right? At least, if let's say you don't make money, and sometimes trading can lose money, right? So if you can't make money after 6 months or 12 months, you can still pay whatever bills that you have. You can still survive. And you think that after 1 year that trading is not for you, you can always go back to the workforce, right? Um, or someone want to invest, your income also is very important to determine your risk profile, your capacity to take risks, right? For example, if I'm a part-time worker and I do not know whether tomorrow I will have a job or not, then my income will not be stable, right? And for those who income is not so stable, right? Or even let's say you're a retiree, we do not want to lose our money, retire money just like that, right? It's really hard earned, and you want to make sure that you have enough money to actually go on with your life, the rest of your life, right? So if you're a retiree, then it's easy. So it's very sorry, not easy, it's difficult to take risk. Okay, so if your income is not stable, and when you're a retiree, when you don't have income, then of course it's very difficult to take risk. Okay, of course the amounts of savings that we have also very important. Now imagine that we have two different traders, right? One who has no money in the account except for 5,000 ringgit, so that's all he have. The other guy who have 100,000 ringgit, all right, in the bank account, savings account, and both of them invest 5,000 ringgit. Okay, both of them invest 5,000 ringgit. Now, which one do you think have more pressure, right? Trader A, who has only 5,000 ringgit to his name, or Trader B, who has 100,000 ringgit? And both of them trade the same amount, 5,000 ringgit. So, of course, Trader A will have more pressure, right? Because that's his savings. If you lose that 5,000 ringgit, that's it. He's finished. He's going to go bankrupt, right? He's gonna need help. Okay. Whereas the 100,000 ringgit guy, even if he loses the 5,000 ringgit, he still has 95,000 ringgit. So again, this affects your capacity to take risks. Okay. Dependence basically got to do with your age, right? If you're already married, okay, let me tell you, if you're already married, your risk, your capacity to take risk becomes even lower, right? Sometimes, like you myself, I think that it's okay if you got accident, or you get sick, or if you die or whatsoever, right? But imagine those who are around you, how they are affected, right? So you start to consider about other people. It's not all about you, but you consider about other people. So then the capacity to take risks has also gone down, especially when it comes to money, right? Because if, let's say, what happens if you got no money at all, right? And you have people who that depending on you for money, all right? So you have to look at all these factors and see where you are currently. What's your capacity to take risks? How much risk you are capable to take, okay, given your current financial situation. So if you think that is really right, if your capacity to take risk is low, it doesn't mean that you cannot invest. You still can. It's just that you have to invest in a very low risk investment. All right, because you cannot afford to go into a very aggressive trading strategy, very high volatile trading strategy, because if your money starts to go down, if you start to lose money, then you get panic. All right, so it doesn't mean that you can very low risk you can't invest. You just have to find something that suits you. So you know what, at the end of the day, a lot of investors or traders will also tell you that whatever trading strategy or whatever trading plan that you build, you have to build something that suits you. All right, that's just very important. Now that's capacity to take risk. Now the second part is risk tolerance. Okay, this is a psychological attitude towards risks and losses. Okay, now this part is a little bit difficult because you have to understand yourself, right? How much risk can you tolerate? All right. So you do not know how. I mean, for winnings, you have to know how you react to your profits when you win. You also need to know how to react on your losses. Okay, two of them are also equally important. It is not just reacting to losses. It's how you react to winners as well. Okay, your profits as well. You know why? Because I also know a lot of traders who have made profits in the beginning. They think that this is it. I am now I'm now the master of trading. I know I'm the master of investing. I know what I'm doing. So now I'm going to risk even more. I'm going to put more money in because I found the right formula and it works. Okay, so your ego goes up so much, and then yes, it's good to have some ego. It's good to have some confidence, but overconfidence can kill you. All right. So be careful with that. Right. So winning money, you have to know how to manage it. Now, losing money, of course, you also need to know how to manage it. Right. So we do not know until we really lose money. Yeah. So really, you have to put money in there, and you have to have a feel. Some people can lose 10% of the portfolio without a blink of an eye. No problem. Some people lose 10% already. It's like the whole world crumble, right? Some people can't even take a 1 cent loss, right? It's like, wow, 1 cent loss is like, wow, the stock market is robbing me. So that attitude is important. How you tolerate with risks. All right. In the initial trading, when I did a lot of workshops, I always mention, especially for trading, because trading involves more risk, right? One of the things that you can do is you know your heartbeat rate, right? If you are relaxing, it's probably like 60 beats per minute, or 70 beats per minute. If you are running, it can go to up to 120 to probably up to 150. That means your heart is really beating very fast. Okay, so one of the things you can do is, you have to put a heartbeat monitor. It's now very easy because you get all the smart watch, these gadgets where you can actually test your heartbeat, right? And then you start to buy shares, right? You open your trading screen. Let's say you buy 1,000 shares. Okay, so when you start to buy 1,000 shares, you click 1,000 shares to buy. Then you monitor your heart rate. Okay, see whether it has gone up a lot. If it's just gone up from, let's say, 60 to 70, that means you can still manage it. All right. Then after that, okay, maybe 1,000 lots you can handle it. Now, let's try 100,000 shares. Okay, so let's say you go and buy 100,000 shares, and then you'll see, I can guarantee you, right? If you buy 100,000 shares compared to the 1,000 shares earlier, your heartbeat when buying the 100,000 shares will be higher when you bought 1,000 shares, right? Automatically. It doesn't matter whether you are a very seasoned trader or investor, or whether a new investor, automatically will go up. All right, even you have been investing for many years. Okay, but the thing about risk tolerance is this: risk tolerance is not static. You can change. Some people may be able to take risk at first, but over the years suddenly you don't take risk anymore. Right, the risk appetite or the risk tolerance become lesser. Or some people who cannot take risk at first, they can take risk better. All right, so risk tolerance are basically affected by a few things. Okay, number one is knowledge. A person who does not have a knowledge of certain things, okay, will definitely be more afraid to venture into that thing. For example, if you want to go for swimming, right? People who are still new and have not swam before, they risk of being drowned, right? They fear water. Okay, but once they start to learn about swimming, then of course they will start to be more confident, right? Their risk tolerance can be better. Okay, now of course, by practice, and practice is where the past experience comes in. You keep on practicing and you find out that it's no problem swimming anymore. Okay, so that risk tolerance can change. All right, now I'm not really I'm not a psychologist lah, right? So you can't, I can only share with you what I know and I have experienced. All right, but if you really want to go deeper into this subject matter, one of the books that you can buy, all right, that actually talks about some of this or most of this, is a book by Dr. Alexander Elder. All right, doctor. So he's a doctor. So he's a psychologist. All right. So it's called Trading for a Living. So that psychologist eventually became a trader. All right. So you can read a book by Dr. Alexander Elder, and it's called Trading for a Living. And that's where he also talks about trading psychology. All right, which I will mention all these things to you guys. You can get more details there. All right. So first thing is your capacity to take risks. That means this is given your financial situation, right? What kind of risk you're able to take. Second is the psychological aspect, your risk tolerance. Okay. Now the third part is your need to take risk. Okay, it's like a measure of motivation to take that necessary risk. For example, if I'm already have enough money, all right, that probably can last me 2 or 3 generations, then my motivation to take risk is lower, right? I may start to invest, but I do not need to invest in a very high risk manner for high profits manner, right? Because I'm already rich. I already got a lot of money. All I need to do is to preserve my wealth and grow it a little bit. Because if you have, let's say, a 1 million ringgit, and even you have every 5 years with a 15% returns, every 5 years it doubles up your money. 1 million after 5 years it becomes 2 million. After 10 years it becomes 4 million. After 15 years it becomes 8 million. After 20 years it becomes 20 million, right? So it compounds, right? So a person who already has money, the motivation may not be to generate wealth, right, but to preserve wealth and to grow it not in a very aggressive manner. As long as I can grow it, it's fine. All right. So their motivation to take the additional risk is not there anymore. I don't need to take that risk. So for me, if I already have a lot of money, right, that lasts me maybe one or two generations, I don't need to invest with very high risk profile. For me, maybe if I even invest in ETFs is good enough, or invest in bonds, all right, as long as my money is able to be preserved against inflation, then I'm happy. All right. So three things, right? That you have to consider. So you go back and try to figure it yourself. Of course, the second part where tolerance to take risks is again it's psychological. So you really need to figure that out yourself. Okay. Now, why this is important? Because when you build your investment portfolio, it need to suit your risk profile. All right. Because let me tell you, we can give you a very aggressive investment portfolio. We can teach you something to trade aggressively, right? But mentally, you are not prepared. Okay. If you're not prepared, then definitely you will not be able to achieve the objective. Okay? You need to find something that suits your risk profile. Then it becomes almost natural. All right. But of course, your risk profile, like I said, your risk tolerance can change. Okay, if your risk tolerance is getting stronger and your capacity to make more money, it gets higher, your motivation gets higher, right? And your capacity becomes stronger now that your income is more stable, you have more money, then you can take more risk. All right. So you need to know first of all your risk profile. I'm glad that I started trading in a young age because my risk profile is the most highest, right? I can put a 10,000 ringgit capital and lose everything. Nobody's going to be affected except me. All right. All I need to do is not don't buy all those branded stuff, don't buy shoes and all that, and wait for another 10,000 ringgit and whack that 10,000 ringgit, and if the 10,000 ringgit doesn't grow double in the next 1 year, I try again. Your risk profile is high. You are a risk taker. You can take big risks when you're young, right? But as we are older, if you ask me right now, no, I will not dare to take big risks anymore. All right. I will not trade. I will not do the way I did 20 years ago. Right, definitely I don't think so I can go through that period anymore where I take that kind of risk. Right. Because it's different. Yeah? People do change. Okay, so you can actually come up with a table. So here I'm assuming that everybody has a motivation to take that additional risk, because if you don't have motivation at all, you may not even want to invest in the stock market, right? Because the stock market provides the best returns among many different asset classes, like money markets, like properties and so on and so forth, right? But the risk also can also be high. All right. So if let's say your capacity to take risk, that means your income is not stable, your age may be towards towards retirement. Okay, your income is not stable, you have a lot of dependents, you don't have the resources to take the risk, right? You can't even lose a lot of money, but you can still take a small risk, right? Your risk tolerance is also low. Your psychologically your risk tolerance is low, so that means if you take low, your risk profile is low. All right. And so on and so forth. I'm not going to go through all this, but this will just give you an idea. Right? For example, if your capacity to take risk is high, your risk tolerance is high, and your motivation to take risk is also high, then of course you are a high risk profile taker. That means you are a gung ho guy. You will go there. It's like you go big or go home kind of guy, right? Then you can invest or into a more aggressive portfolio. All right. Okay, so now I'm just going to go through it briefly with you because, like I mentioned earlier, in the previous webinar on the balance between risk and rewards, Alvin has already gone through with you guys. So I'm just basically going to show you how this is all set up into a portfolio so that you get an idea. All right. So basically, I'm just going to share with you very shortly, right? What this category of stocks has to do with risks. All right. Now, for example, if you have an investment grade stock, right? Investment grade, that means it's strong. Every year it makes profits. It has strong positive operating cash flow. It has good cash flow management. It pays dividends every single year without fail, and this is consistent throughout the years. This is we consider investment grade, right? And investment grade stocks normally are very high price. Stocks like Nestle, like a Dutch lady, you know, they're very consistent, right? Just the investment grade, they are slow and steady, okay, but their returns, okay, may not be as good as the other categories. Right? Why? Because if a good company, the demand for that company is always high, right? The demand for their shares is always high, where supply is lesser. So people will keep on buying, okay, and the share price will always be high. So for example, if you buy most of the investment grade stocks today, if you buy at current price, you probably get about 2 or 3% yield, dividend yield. All right, so that's very small, but of course it's steady and stable. All right. um, we have the emerging grade of stocks. Emerging stocks, that means these are stocks that have been around for a few years and they are growing. All right, for example, small tech companies that are still growing, they are all emerging. All right. They have very high growth, okay, but the problem with this is because their growth is high, they need to continue having money to reinvest, okay, into technology, into expansion, into many things, so that they can continue to grow fast. So if they use their profits to reinvest, then investors will not get dividends, or very very low dividends, because this company is growing. They need the money to keep on pumping up. All right. And now, of course, on the left hand side, startup companies are we call it the highest risk, because there is no track record. The moment they start to list, let's say they start to publicly listed in a company, that's when their financials are all out for people to see. Because when they are a Sendirian Berhad, before they go in listing, they can keep the accounts. They don't need their accounts to be shown publicly, right? So startup companies are new companies. They just got listed, because we don't have any track record to see how they are performing, so their risks are considered higher. All right. And of course, in between, there are also cyclical stocks that move in cycles. For example, like normally plantation companies are cycles, right? Because we have period where demand is high, we have period when the production is high and low, and so on. So they have certain cycles, right? Then sunsets are basically industries or sectors that are losing, that is going down, right? No matter how the business is going to run, it's not going anywhere, because the whole industry is coming down. All right. Turnaround are companies that are already starting to be sunset, but because they change maybe their business, or they change their management, they change the way they do business, they may start to turn around from being a sunset industry. All right. Of course, the one that is at the top, okay, normally has lower risk. The one at the bottom has higher risk. So what we did was we actually did a profiling among these categories of stocks. All right. So investment grade has lower risk, yes. Okay. Then it goes to emerging grade, cyclical, turnaround, sunset, or falling, and then startup or speculative, right at the bottom where the risk is at the highest. All right. So we need to basically know, first of all, when you want to buy a particular stock, you need to at least try to figure out, where it belong to, right? Which category it belong to. And I think in the previous webinar, Alvin has given you a lot of examples, and I guess you guys have also asked him questions on this. All right. So I'm not going to go through your detail. I'm just basically again want to show you how a portfolio is built depending on your risk profile. All right. Now, so if you want to have a portfolio, build a portfolio, in every portfolio, if you want to have a consistent portfolio, okay, normally we will put a higher percentage for investment grade, or let's say even emerging grade stocks, because these are like the pillars of your portfolio, right? Normally, let's say investment grade, let's say you put 50% of it are investment grade stocks, okay, and the rest of them, let's say, other stocks, okay. So that what happens if, let's say, if the market falls, right, quite aggressively, your investment portfolio will not crumble, because you have these investment grade stocks that hold steady, right? So it does not affect your portfolio that much, okay. But of course, when the market really grows into a very strong growth as well, your portfolio will not be able to grow as strong, because you have these investment grade stocks which prices are already high and steady, because their weightage is so high in your portfolio, then it will not really be affected by sharp market movements. Okay, so of course the startup, you can also invest in startups because the risk is high, but the potential returns can also be high. All right. So you need to have a balance in your portfolio. Okay, so of course you have to build one first. Okay, so the first thing is to start building your portfolio. Okay, whether you want to you want to start a open-ended portfolio or you want to start a closed-ended portfolio. Closed-ended means you need to give it a specific time when the portfolio ends. For example, it's a 5-year portfolio. That means you want to put your returns at one time, right now, and then see what happens with your capital that you put in, okay, after 5 years without disturbing your capital. That means no withdrawals, and I say not even adding more money, right? But whatever dividends you receive, you reinvest back into your portfolio. So that's a closed-ended one. So start now and then hold up until 5 years. Okay. Second one is of course open-ended. That means you can withdraw if you want to, if you need to, all right, or you can add it back. Okay, and of course your dividends can be reinvested back, or you can withdraw. So it's more, there's more flexibility. All right. So when you do the withdrawal and all that, when you withdraw means you get back your money, when you add more money, when you add more capital in it. Okay, you just want to see at the end how much is your portfolio. All right. From the beginning, let's say in the five in the next, you put a 5 years portfolio. You want to just look at after 5 years, see what happens. Okay. But then again, it's very difficult because we can also sometimes lie to ourselves, right? We can put the last year you just put, you have, let's say you have a 100,000 portfolio, and then throughout the years you reduce or you withdraw until now only left 50,000. Okay, and then the final year, on the 5th year, you put back another 100,000. It becomes 150,000, right? But so it looks like your portfolio has grown, right, for 100,000 to, let's say, 200,000, right? But it's not a real portfolio by investment, because your investment or your income from the investment or the returns of the investment actually comes from your injection of capital. All right, so it's very difficult to calculate. Of course you still can, but the calculation is more complicated lah, to find your actual returns from your investment. All right, because if you put 100,000 ringgit in, it's just inside your cash, but without investing that 100,000 ringgit, that means that 100,000 ringgit is just lying down there without doing anything. So that's not investment capital, right? Investment capital is when you put the money in there, that money has to be invested. Okay, so these are basically just a guide. All right, what kind of returns that you'd be expecting from these different categories of stocks. For example, investment grade, you're probably expecting about 8 to 10% CAGR over a period of at least 5 years. And we're talking about 5 years. It's not that 1 year you can get 8% to 10% returns, right? So 8 to 10% return, including the capital gain. This is total gains, right? Capital gains plus your dividends. All right, if just dividends alone, you will not be able to achieve 8 to 10%, right? So it's probably like 2-3%, right? Because that's what you get a dividend yield currently. But of course, for if you include capital gain, then your CAGR can go about 8 to 10%. So emerging grade companies, mostly like tech companies, the one fast growing ones, basically have about 15 to 25% CAGR. Cyclical one has about 15 to 25%. Turnaround stocks 15 to 25%. Sunset will not have anything, not expect anything. Startup, you expect price or even the returns to even go down more than 25%. All right, why? Because you can buy a stock which is 1 ringgit, and maybe after 1 or 2 years it goes to 75 cents or 50 cents. Okay, because you don't have any, the risk is high because it doesn't have any data, right, or enough data to show you the consistency. All right, but this is again is just a it's not really this is just an expectation now. Okay, an aggregate is not really, but some stocks can really go up, right? I mean, emerging grade companies can even go up, like 30% or 50%, even let's say you compound it in the next 5 years, right? So not necessarily, but this is just average over the industry, or average when we did our study among all the categories of stocks. this is where it ranges. All right. So you'll be thinking, Top Glove is an investment grade company, right? So this year itself is 3 years. Okay, but like I said, it's only this year. What we are talking about is the next 5 years, see whether it's still able to provide the kind of returns. All right. Because when we invest, it's not just investing right now, okay, it's investing over a period of time. So like for those, for example, I know a lot of even people who knows me, a lot of them say, yo, I've regretted not buying all the glove companies or whatsoever, because these are companies that gone up so much, right? 2 times, 3 times, 4 times, some even 6, 7 times, but they did not make money because they did not buy those shares. Okay, but I told them that the stock market is always there, right? Is if you miss this, make it a lesson, but as long as you are able to get the returns that you want consistently, that's more important. It's not that making 1 year like this, right? You make 300 and 400% returns only to lose everything next year. Okay. um, it can happen, right? Because you tend to overinvest, especially when we have the mindset where we think that, you know what, I already have profits. This money is from Bursa Malaysia, right? This money I made profits from the stock market, so I lose also, never mind. Okay. No, that kind of mentality will be actually quite destructible. All right, because that's just a start. You're willing to lose that money, then eventually when you really lose that money, then you are willing to also lose your other capital, additional money. Okay, you have to remember that it's very difficult to build 300%, for example, right? Your returns, let's say in the next 1 month, is 300%. Okay, 300%. It looks very difficult to grow 300%. But you know what? It only takes 100% fall to wipe out everything. All right. So bear in mind, we have to be careful with the mindset that we have. Okay. So you have to basically plan to meet the objectives. You need to decide a combination of strategies. Okay. So remember, um, you can have a conservative portfolio or a risk-loving or aggressive portfolio. Okay, a conservative portfolio means that you're not willing to take higher risk. Your capacity to take risk is lower. All right. You still want to take risk, but you cannot take so much risk. Okay, so you low risk. And a risk-loving one or an aggressive portfolio, okay, that means you call risk loving because you love risk lah, right? So you are being aggressive. That's where a person has a capacity to take more risk. All right. And then it can be divided into a more focused portfolio or a diversified portfolio. I'm going to talk about this in a short while. Right? What does it mean? Okay, this is where your risk tolerance comes in. Okay, so if you are able to create a conservative portfolio, that means you have the capacity to only take low risk. Okay, building a low risk portfolio, but you are willing, emotionally you are willing to take a little bit more risk. That means you can be a little bit more gung-ho. Okay, you can lose whatever money that you put into your portfolio because you have already accounted that for. Okay, you are already being very conservative. You have 1 million ringgit, but you only invest, let's say, 10,000 ringgit. That's very conservative lah, right? So you can lose all that money, but again, I do not want to lose all money because I naturally am a risk adverse investor. I cannot take a lot of risk. All right, so I only able to risk that kind of money. Okay, but I can be a little bit more aggressive, so I can have a more focused portfolio, a little bit higher risk tolerance. Okay. So you can have actually a combination of a few. So if I'm a risk-loving portfolio, I can create a portfolio that has more, instead of investment grade stocks, I will have lesser investment grade stocks, but more emerging, more startups, okay, more aggressive one, more turnaround stocks, or even more cyclical stocks, but less investment grade. Okay, that's being aggressive. For a conservative portfolio, I will have more investment grade stocks, okay, and very little other stocks. Okay, now then a focused and diversified portfolio is this. So if let's say you have a conservative portfolio, okay, you are conservative, you don't take a lot of risk. All right, now if you want to have a risk which is even lower, in that portfolio, when you have so many investment grade stocks, okay, the number of investment grade stocks is also a lot. All right, so you diversify some more in your investment grade stocks. Investment grade stocks can be from consumer, it can be, let's say, from manufacturing, it can be from, let's say, even REITs or whatsoever, right? It can be that. Okay, so you diversify it some more. There are more stocks in your portfolio, or you can be a conservative investor with a portfolio. And because you want to take a little bit more risk, I don't want to have too many stocks in that portfolio, too many investment grade stocks. I only focus on a few. All right. So if you still remember the previous lesson, if of course you have fewer stocks because the portfolio movement or returns or risk will be depending on that few stocks, right? If you are diversified, that means you have more stocks into that portfolio. If, let's say, a few stocks fall, it does not affect the portfolio that much. All right. So being a conservative plus having a diversified portfolio, you are actually want to get a very low risk investment portfolio. All right. If you are a conservative portfolio with a little additional spice, maybe put a little bit of chili into your food, okay, then you can be a conservative portfolio, but you are being more focused. I mean, you're focusing on just a few counters in the investment grade stocks, okay. Or you can be a risk-loving, an aggressive investor, love to take risks. I will have less investment grade stocks. I will have more emerging, more cyclical stocks, right? Then, as a aggressive investor, okay, I can also be focused or diversified. That means I can take risks, right? I have the capacity to take risks, but my risk tolerance, my psychological mindset is not ready to take big risks. So I can actually have more stocks into that portfolio. It become more diversified. If I'm a risk-loving portfolio and I can even take higher risk, I have a higher risk tolerance, then I can even focus on a few counters. All right. So normally for traders, right? Traders normally you have to be aggressive because you want to make more money in the short term, right? You need to find stocks that move because normally investment grade stocks don't move that much, right? But other speculative stocks, they move a lot. Okay, so you have to be able to take risks. So if you want to be a trader, okay, number one, you cannot be conservative. You need to be a risk-loving investor or trader. I mean, it's a person who is more aggressive. Okay, if you are a conservative trader, investor, if because by nature you are conservative, don't try to be a aggressive trader. Maybe over time you can. When you start to develop your risk tolerance and your capacity to take risks will be higher, you can switch to become a trader, right? If not, stick with investing first. Okay, over the long term, build a conservative portfolio. Okay, so a trader normally is a risk-loving portfolio, a risk-loving investor, and normally they are also a focused portfolio because you always focus on a few counters to grow your trading fast. You cannot be a trader, but you have 30 or 40 stocks in your portfolio, right? Definitely you can't be a trader because a trader will only focus on a few counters. So the trader category is basically a person where your capacity to take risk is high, okay, and your risk tolerance is also high. Okay, for a person who can't take risk, then you can go invest. For a person who don't even want to take any money out for investment, they only put money in your fixed deposits, then you are a very conservative. Your capacity to take risk is zero, your risk tolerance also zero, and your need or your motivation to make additional money is also zero. Okay, so that means you don't need to invest money in the stock market, you just put your money into FD. All right, or maybe unit trust or whatever other or any other money markets where you have very low risk, but your returns are slow and steady. Okay. So in the stock market, of course, you have to take additional risk. Okay. But you can manage the risk by knowing what kind of portfolio you want. So this is just to give you a diagram, right? If you are a risk-loving and very focused, remember I told you about you are being a trader. That means your volatility and returns are expected to be high, but of course your capital at risk will also be highest. All right. If you are risk loving and diversified, that means you are still a risk taker. You can take risk, but you diversify your portfolio. Okay, you do not expect a lot of volatility. Okay, but your risk can also be high, but not as high as the trader one. Okay, not as high as this, so it's lower here. Okay, then we have the conservative and focus. It's less aggressive. You are conservative, but because you are being more focused, your risk is a little bit higher. Okay, so your volatility, because you're focused, you only focus on a few stocks instead of a big diversification of stocks. All right. And then your volatility will also be high because your one is focused. But if you're conservative and diversified, you're expecting lower returns, but your risk is also low. And of course, volatility will also be smaller. All right. So if you are someone who can't take the roller coaster ride in the stock market, okay, sometimes again you can do your heartbeat test, right? For example, what happens if you are invested and then suddenly the Dow Jones Industrial Average fall 2,000 points? Now 1,000 points, 500 points, no rasa, right? No feeling. But if it goes down to 2,000 points, what are you gonna feel? All right. So if your heartbeat race like you are a runner, you are sprinting, that means you know that I cannot be I cannot be an aggressive investor. I cannot be a risk-loving investor. I have to be conservative. All right, because if you have a very conservative portfolio, remember the conservative portfolio means you have a lot of investment grade stocks, lesser other stocks, right? And it's diversified. That means a lot of counters inside your portfolio. So even if the Dow Jones fall 2,000 points, your portfolio may be affected a little bit, but it will not be a lot. Okay, so if you are that kind of investor, then you should build that kind of portfolio, right? But whatever it is, when you build any portfolio investment, make sure it's better than any other passive returns. For example, it has to be better than FDs, definitely, right? If your conservative and diversified portfolio only returns you 3% annually or KEGA, then might as well you put your money into FDs. All right. If it's let's say even below 5% or 4%, benchmark is normally 5% because ETF also can pay you 5% or 6%, right? So if you cannot even make 5%, then might as well just give your money somebody else or fund or buy in the ETFs or unit trust or whatsoever to get that kind of returns. Why do you need to build a portfolio so difficult? All right. So if you can build a portfolio which is let's say even conservative and diversified, and you make 8% and 10%, then that's fine, right? Um, as long as you can build the low risk investment asset class, right? Then of course you can always build other portfolios. You can later build a trading portfolio if you want to. If you have additional money, or once you have to again look at your risk profile, right? Maybe now you get a more stable income, so and let's say you're not married, that means your risk profile is still very high, and now you got more money, you got more savings, then you can start trading. Okay, so you are also, like I said, you have to look at whether that trading plan or a trading strategy or investment plan, whether it suits you or not. Okay, that's very, very important. Okay, so this is just an example, right? So if you are you're a conservative investor, maybe you have, let's say, a 70% of your portfolio all investment grade stocks, and 30% is all the others. All right, so here you're probably expecting a returns of 8 to 12%. Okay, that also being able to find the right stocks lah. All right, and like I said, in the previous webinar, we've already covered this, so I'm not going to cover this right now. I'm just basically showing you how you actually put them into a portfolio. Regarding stock picking, that is another lesson altogether lah. All right, so just continue to be with us. We'll continue to show you how. Okay, then we can also have a moderate portfolio where you have 50% investment grade stocks and the rest are 50%. All right. So this one you can expect a little bit higher returns, probably 13 to 17% returns. Okay. But of course not as high lah, right? So again, it depends, right? Because if you are able to build a moderate portfolio where you are able to keep, let's say, 15%, then you have to look again, right, at the rule of 72. If I can make 50% compounded year by year, I mean, let's say over the past 5 years, if I can make consistently and it's consistent and I don't need to do a lot of things, right? That means I can, my returns or my capital can grow can be double every 5 years. Okay, 72 divided by 15. Okay, so that's how you can actually calculate how fast you can achieve your objective, right? Uh, so it's very important to have an end in mind, right? What you want to achieve first. All right. So you are more aggressive, then you have very less investment grade stocks, right? There are more other stocks. There are more maybe speculative stocks, maybe more emerging grade stocks, more cyclical stocks in there, more startup stocks, okay, more turnaround stocks, but very little investment grade stocks. So these are more aggressive. So your expected returns will be high, but of course, when you shift this, right, when you have lesser investment grade stocks, you're expecting higher volatility, right? You're expecting a roller coaster ride, and your risk can also be high. All right. So that volatility and that the volatility is the one that normally kills what makes an investor lose money. All right. Why? Because some people can have that tolerance. Okay. For example, right, for example, this is an example. Let's say we have two same investor, two same portfolio, right? Both of them have R1 million in their portfolio, okay? And they have only invested for 2 years. 2 years, okay? Both of them same time, same investment, same objective, close-ended portfolio, right? That means they cannot take out money, and they have an objective of 5 years. Okay, so two of them is the same, but the only difference is two of them are two different people. Okay, so both of them entered. Then the second year comes in. Or let's say we have this COVID-19. Suddenly prices fell 30%, and their portfolio fell 30%. Right? Fell 30%. So portfolio A, because let's say the trade investor A has a higher risk tolerance, and it says, you know what? It's not 5 years yet, right? Because this may just be a temporary setback. And I know that over time the stocks will come back and it will continue to grow. All right. So I can take that 30% fall. Whereas the second investor cannot take that 30% fall. He cannot sleep at night. The moment he fall 20%, he already sweating at night. The moment he fall 30%, he's sleepless. All right. Suddenly, a person who has a perfect health condition now has high blood pressure. Okay. It does happen, right? So that means you cannot take the risk, right? And when that happens, you guess what this guy did? He said, you know what, I think I better sell now. Because if the market falls some more to 40% or 50%, I'll probably get a heart attack. I can't take it. Okay. So that person will sell off his all 30%. And then that's it. He said, okay, never mind. At least I sell. I know it hurts to lose 30%, but at least I still got my life. Right? I still got my 70% money. Okay. So that person gotten out. Then the market start to rebound and start to go up, and now it's even higher than that he eventually invested. So what happened now is investor A now eventually start to make his profits back again, right? Whereas investor B, who's already sold out, right? That's it. He didn't buy back again. And let me tell you, once you sell, it's always difficult to buy back again, because when it goes up so high, you think that, oh yeah, I should have. Oh, now if I buy now, I'm going to be buying at a even higher price in my initial cost. Then the psychology comes in and says, you know what, cannot lah, forget it lah. So that person, investor B, will never make back his money. All right. So that's why I said it's very important to know your mindset, right? Your psychology, your risk profile, especially, right? So you really need to look at the three aspects I've just shared with you. Okay. Right, so that ends my presentation today. Like I said, to pick the stocks for investment grade or and so on and so forth. Again, that counts for another topic altogether, right? Because here is just to give you a foundation on how you manage your how to build a portfolio. Okay, by understanding the risk, your risk profile. Okay, once you have this foundation, once you have found a portfolio that you want to build, the next thing is to how to find these stocks and put them into your portfolio. All right. So I hope that gives you an understanding, first of all, how to build an investment portfolio. Yes, we want to minimize our risk. That's very important, because number one, it's not just monetary risk. The thing about money risk is money or emotions is very tied to money. All right. Now imagine if you just use monopoly money and play. When you play monopoly, yes, when you lose money in monopoly, it's not because the emotion is not because you lose that money. The emotions that you have, the lousy emotion, is because when someone wins the game. All right, it's not the lousy emotions or that lousy feeling that you have when losing a game is different from the feeling of losing money. All right. So if you just do paper trading, no problem. But when you put real money in, a lot of things can happen. All right. So again, to understand your risk tolerance, you have to try. All right. You have to try to invest and go through the volatility in the market, and that's how you discover what kind of risk profile that you have. The capacity to take risk is easy to understand because you can see how much money you have, because capacity to take risk is basically based on your financial situation. All right. Okay. So you have any questions, you can ask the questions. I'll I only give you that link to download the slides, so you have to be with me in a short while. Then only I'll show you the link, right? So that you guys will stay with me. Okay, so I'm just going to answer your questions. So you have any questions, you can ask those questions right now. All right. Yes, there will be Ask Anything Sunday. Yes, every day will be on. So tomorrow we'll be on our Equity Tracker Facebook. You can ask anything tomorrow. Okay, let me go to any example of close-ended stock. No, not close-ended stock, close-ended portfolio. There's no such thing as close-ended stock, right? Close-ended portfolios, there are not many of them. Okay, one of them is actually listed. There's only one close-end portfolio, close-end fund that is listed in the stock market, and it's called iCapital, right? You can go and check it out. It's called iCapital. Okay, Ng Leong Jin. Okay, after suffering losses from consecutive high risk trades, do you readjust your risk level as part of the plan to recover it? Now, the question is, if you have suffered those losses, how did you take it? All right. If you cannot take it well, and the results of your losses is because the way you cannot manage risk. Remember, I give an example of trader A and B, right? The reason why this guy lose money is because he is not prepared to take that risk. Okay, he maybe cut his losses too short, or maybe because the portfolio came down too early, he got scared, and because of his fear, he gotten out, and that caused him to lose money. Right. So if that happens, that means you really have to look again at what kind of portfolio you're going to build. You're not going to fight back into the same trading plan or strategy that you did before, because you have really lost money in that strategy. You have to find a different one that suits you. All right. So I know it's difficult, because you'll be thinking that, you know what, because I've really lost money. And one of the things, right, a mindset that every trader or investor must have is this: trying to make back the losses as soon as possible. Okay, now that's a gambler's mindset, right? It's very important. How do you know gamblers? I think a lot of gamblers will know, right? People who gambles will know, right? Because when you start to lose some money, what do you do normally? You double up your bet. You want to make it as fast as possible, right? And sometimes by doubling, then suddenly it becomes 4 times, it becomes 8 times. Because you want to make back that lost money as fast as possible, right? And we are not willing to make back slowly, right? Because you think, oh, it's going to take me a very long time to just recover my losses, right? Then you'll be thinking that, yeah, difficult. I need to find something which is more aggressive, right? Find ways to make as much as money as possible. And that's one of the reasons why, because of that mindset, we fall into scams. All right. Someone who promises, because you know why? A lot of these advertisements always hit you right in the heart, right? Because you already lost money, you want to make it as fast as possible, and then somebody said, you know what? I've got a solution for you. Okay, then you follow that guy. Okay, or you follow the investment plan because you want to make back that money as fast as possible. And furthermore, you think that, what has I got to lose, right? I've already lost so much, lose some more also, never mind. Okay, that kind of feeling, that kind of gambler's mentality. Okay, the best is, you know what, start everything back at zero. Okay, the losses that you made is history. Okay, you start counting back from right now. That means if you have made 5%, that you have made 5% already from the markets. You have made 10%, you have made 10% from the markets. You make 30%, you make 30%. Forget about the losses that you made. Maybe let's say you have down 40%, 50% previously. Forget about that. All right. You start back, and when you start back properly and your portfolio start to make money, you should start that as ground zero and continue to work on it. Forget about the earlier losses. Don't take revenge. All right. Because most of the time, those who are revengeful, those who want to take revenge in the stock market, they will get beaten up even more. All right. Start from ground zero. Start from zero. It doesn't matter, right? Don't balance your losses back again with your wins. Start now. All right. Especially if you have not have an investment plan or you don't have the knowledge or whatsoever before, you just invest based on what people say, tell you, and all that. Right. Those losses, you forget it. Right. It's not your fault anyway. Start proper. All right. Be a well-informed investor. Start proper. Delisted and relisted again. Okay, it depends, right? For example, like Maxis has been relisted and okay, that can be considered as long because you can also look at the financial results previously. It could be emerging, it could be investment grade. There is a criteria for being investment grade. There's a criteria for being emerging. Like I said, this has already been mentioned in the previous webinar. So if if you want to know more about this, then go back to the previous webinar. It was last week, right? Go back to the video and listen to it. All right. Okay. Let me go to your no, but how do you manage your risk in the trading portfolio? Now that's a very important question. Right now, when I started trading, I used to be more aggressive, right? I always have like the mentality where if I lose 10,000 ringgit, I'm prepared to lose that money, but I'm trading at a very high leverage product. I'm trading the futures market, right? So my expected returns was actually 100% every year, right? So I'll be trading and trading and trading to achieve the 100. In fact, I'm able to do it more than 100%. In fact, every year for I think for about 3 to 4 years, right? So I made that money, and then after that, I start to be less aggressive. Along the way, I try to find something that suits me because I do not want to be a trader, for the rest of my life, because it's very emotional, it's very stressful. You look at the markets every day and trade, right? So what I did was I tried to find a strategy where I don't need to look at the markets every day. I try to be less aggressive, right? But I can still achieve my targets. All right. So now I don't really trade intraday that much. Okay, unless if the stock I bought that day went up into a target price that I met, then I of course exit the same day, right? But generally I don't really trade intraday in and out anymore. Okay, I need to find time to do other stuff. Okay, so normally what I did right now, my own strategy is even for trading, whenever I trade, I will not risk that trade more than 2% of my portfolio or my trading capital. Okay, now when I have that mentality, that means right now, for whatever stocks that I buy for trading, the stop loss amount should not be more than 2% of my capital. That means whenever I lose, let's say hit the stop loss, I know that I'm only going to lose 2% of my capital, right? For every single trade that I lose, only 2% each. If I have that kind of mentality, then it's very easy for me to be prepared, because whenever I lose, I know how much I lose. Maximum 2% of my portfolio. 2% of my portfolio. Never go more than that. Okay. So how do I make it to become 2% of my portfolio? Is the amount of money you buy that shares. All right. Just to give you an example, very simple example. Let's say you bought a stock which is 1 ringgit, right? Or let's say, to make it easier to calculate, let's say I have 100,000 ringgit. Okay, I have 100,000 ringgit. Okay, I want to buy a stock which is 1 ringgit. Okay, and put a stop loss at 90 cents. That means my risk is 10%. True, 10% risk, right? So if I put all my 100,000 ringgit to buy this one share, okay, that means my risk is 10% because all of my money is in there, and my stop loss is 10%. Correct? So that's 10% risk. So how do I make it 2% only? I divide my capital into 5. right? Because 10 divided by 5, 10% stop loss divided by 5 is 2%, right? So instead of 100,000, I put in 20,000 to buy this stock, 1 ringgit. All right, so I only buy 20,000 ringgit, isn't it? So if the stock goes down 10% and hit my stop loss, I will lose 2,000 ringgit. 10% of 20,000 ringgit is 2,000 ringgit. So 2,000 ringgit against my 10,000, 100,000 ringgit is only 2%. That's how I manage the risk. All right. Okay, while I'm talking, I'm just going to share with you the link. I think my colleague already shared it to you. Guys, so you have to fill up the evaluation form, and then after you fill up the evaluation form and email, make sure you send in or write in your correct email, because the download link will be sent to your email. All right, let me go through your other questions. Can the investment grade securities include bonds too? No, we are talking about stocks. Bonds are bonds. They are not there's no category. Bonds are basically bonds lah. Okay, they are low risk. They are not like stocks. Stocks, we give them into different categories, right? So bonds has its own different. It's not just different category. It's a different asset class, right? It is safe. You get back your money, but don't expect high returns. All right. So investment grade stocks has slightly higher risk than bonds and has slightly better returns. Okay. Are robo advisors, where is the question? Robo advisor is a good place to start investing based on portfolios and respective risk appetite, like stash away. Yes, you can start with, all right. But again, you have to monitor what kind of returns that you'll be looking at over the years, all right, because they are also like, as far as I know, most of the robo advisors here in Malaysia are all investing in ETFs, which actually you can do it by yourself also, right? But if you want someone to manage for you and you want to be passive about it, and as long as it can achieve the returns that you want, then by all means go, right? Start investing on those robo advisors, but make sure you look at the returns that you're expecting. So you will not be able to see your returns maybe after 3 years, or even let's say 5 years. So after 5 years, you can see the returns. Don't just look at the results, because you have to factor in a lot of other things, right? Like um, um, the fees that they're charging, the sales charge, the spread, the commission, and all. You have to put that on the account, and then you look at the performance. Okay, so as long as it suits you, it brings the return that you want, go ahead. Okay, but if it does not, if you only bring so little return, and you can do the rule of 72 again, right? If let's say you only get a 7% return a year, 7%, that means it takes you 10 years to double up your money. All right. So again, it really, if it suits you, by all means, go ahead, right? If not, if you want to, if you want a higher investment returns, then you probably, if the higher you want it, the more you want, then the more you have to do it yourself. All right. Value investing, build character, train planning. Yes, investing takes a long time, right? So that's why it's good to have the right start, right? And it's good to start investing now, because that's why we learn maybe after the 5 years, is for you to consolidate your strategy and see what kind of returns you're expecting. And then in that 5 years, you learn about yourself. And then really after that, you will just go on as you will go a smooth ride. Okay. At the first, it may be a roller coaster ride. Yes, mindset is always the most difficult part lah. All right. All right, guys. So I guess I've answered most of the questions, and it's really 9:30 p.m. And I see the numbers are already dropping as well. I want to thank you guys for attending to tonight's webinar, and hope that you have learned a great deal about portfolio, and especially when it comes to your own risk profile. Right. A lot of traders have actually told me as well that once you start to trade in the stock market, you will actually discover yourself about money. All right. So wish you all the best in your discovery. Wish you all the best in having the right mindset to invest, and I wish you all the best in making profits and your returns that you want in the stock market. Right. So please do attend. And lastly, also go to bursaacademy.com/academy to get more details.
on e-learning from Bursa Malaysia itself. There are a lot of resources that you can find there, right? And continue to learn, right? I think as an investor or trader, one of the things that we always do is we always continue learning. All right. So thank you very much, and we'll see you again. Good night, everybody.